Hello, and welcome to Fintech Surge Podcast, creating a wealth of opportunities through fintech innovations in the Middle East for the Middle East. Powered by Fintech Surge, the region's leading fintech festival, hosted by Dubai World Trade Center alongside GITEX Global.
We are holding these webinar series bi-weekly, and we are very happy to have Stéphane here for a 10th recording. Thank you so much. Hello.
Hello.
Hi. Could you please introduce yourself with a little bit of background from your financial background as well?
Absolutely. First of all, thank you for having me here. And it's always a pleasure to chat, especially about Bitcoin and the crypto asset economy. I've been trading most of my career. So the better part of my career I've spent on the trading floor in funds, in hedge funds, or in proprietary trading capacity at different banks. And I've been trading equity derivatives, really. So I've had the luck of being exposed to many markets. I've worked in Japan and Singapore, in the US, in the UK, in Europe. So I've seen a lot of things in terms of markets, market behavior, market models, product, and so on. And what I've been doing mostly falls down in two categories. Number one, electronic execution, which can be seen as startup when it's principal capacity, or it can be algo trading when it's agency capacity. And then the second thing that I've been doing is securities finance, which is really collateralized finance and so on. And we see a lot of that happening in the crypto space. So both are becoming more and more relevant. And I started looking at crypto when I left my last position, which was at a small investment bank in Paris. I was very curious about the crypto space. And being an equity derivatives trader, the first question I ask myself is, number one, what are those things? And then when I had an idea about what those things were, or a fair idea, I figure, okay, it seems to be trading a lot, but are those really liquid? Is Bitcoin and those assets, are they really liquid? I couldn't find the answer, or a satisfactory answer. And I'm sure we'll come back to that, what it means in terms of institutional standard, a satisfactory answer about liquidity. So we decided to start the company Sun Tzu with my associate and someone who's also been exposed to the crypto space. And what we do, and again, I'm sure we'll come back to that, we propose transparency. We offer transparency in the world of electronic execution, liquidity, pre-trade, post-trade, and a number of things that regulators have found to be quite critical in the traditional space, but lacking in the space of crypto. And so we are trying to bridge that gap.
Thank you. And we are joined here today with the manager of Future Blockchain Summit, Oscar. Would you mind introducing yourself and starting off the conversation?
Yes, thank you for having me, Hayate. I work with Dubai World Trade Center, and we've got the Future Blockchain Summit coming up on the 6th, 10th to the 13th of October, where Cointelegraph will be joining us along with Sun Tzu Labs. We met in France actually back in April at the Paris Blockchain Week, and I was absolutely fascinated by what they are doing, and it really opened my eyes as to what the issues are with crypto exchanges and crypto trading, and what really needs to be done to get it on par with traditional finance. So I'm looking forward to this discussion. Stéphane is a professor in finance at the University of Bordeaux, and it's not often you get the chance to really go in depth with someone with deep experience from both of these worlds, and hope to get a chance with you, Hayate, to really delve into many of the challenges that are facing regulators as well, to deal with what we've seen in the last month with market volatility and systemic risk that many of these funds have had. So how shall we kick off the discussion?
Yes, I would definitely like for you to start with all these risks that you see and addressing that with Stéphane, and what you think the transparency and regulations should work on this matter.
So you're starting me on risks, right? Okay, fair enough. That's a very interesting question. The thing about we've taken a lot of time thinking about risks at Sun Tzu. We're looking specifically at transparency and risk, but beyond the transparency and risk, it's very interesting to look at what the traditional market has become in terms of risk management, and what the crypto market is about to become. Number one, the first remark you can make is that there are very similar risks in both spaces, but the crypto adds more of those. Unfortunately, it's not a less risky environment. Let's take a few of those examples. For example, cryptography is one. I mean, you don't have any cryptographic risk in traditional markets because, of course, you have cryptography technology and so on, but it's not so exposed. Number two, you have an on-chain, off-chain dichotomy in the crypto space, which you don't have in the traditional space. And so those two, for example, are new. They are nowhere to be found in the traditional space. And then the KYC, AML, know your customer, anti-money laundering questions for crypto space takes a whole new meaning because of where the technology comes from. Okay, so you have that risk obviously in the traditional space, but it's much it's more mature, so it's better understood and it's better managed. So the first remark is really, okay, when you look at risk on both sides, you have to realize that there is more risk in the crypto space than there is in the traditional space. Okay, so that gives you a sense of where you should be looking at with an entirely new eye, a new analysis grid, which you don't have elsewhere. Okay, cryptography, the wallet, and all those things, plus the fact that on-chain and off-chain are really different. So that's the first remark. The second remark, even if you look at common risks, they are not of the same magnitude. Okay, the most common risk in the crypto space is one that has been dealt with for a long time in the traditional space, and that's the counterpart risk. Really, what the traditional space has been trying to do, regulators, market practitioners, everybody has been trying to address or mitigate the counterpart risks, the fact that somebody could run away with your money. Either you enter into a transaction and then that transaction is not settled properly, so you send the cash and you don't receive the asset you were supposed to receive. That's one type of risk, or the fact that somebody would take your money away from the system and steal it. That's second type of counterpart risk. So there are different subcategories of counterpart risk, but in the traditional space, everything is arranged to get rid of that risk. For example, governance. You have a three-stage governance in traditional space. You have front office, middle office, back office. That seems to be very complex and costly and useless. The fact of the matter is, it is very complex and costly, but it's not useless because it means that at one single point in time, nobody has enough information or enough power or enough secrets to go with the money. It also enables what we call a reconciliation process, whereby before a transaction is fully registered, a few pairs of eyes have had a chance to look at it. Okay. Now, this is in traditional space. In the crypto space, this is the most common and the most prevalent risk. The fact that when you're trading on exchange, for example, you have a custodial exchange in front of you, so you're sending money and cash to an exchange, which, by the way, is not regulated. So you have no guarantee whatsoever that you will get your cash back or your crypto back, except the fact that the exchange has reputational risk. And in some cases, it's regulated, but in most cases, it's not. And that counterpart risk is extremely important because it essentially means that you can lose 100% of the money you're sending. Okay. And that I think, and that's my opinion, but I've heard it a number of times, that I think is underestimated in the crypto space. Okay. The fact that you have compensation clearinghouses, the fact that you have centralized clearinghouses in particular, but centralized risk management in terms of exchanges and so on. This is all meant to mitigate that counterpart risk in cash and derivatives product. In the crypto space, you can do that in many ways, but if you don't accept a certain degree of centralization and risk management, then there's no way you're going to get rid of your counterpart risk. Let's see, that's the balance between centralization and decentralization. In terms of risk management, you can take it any way you want. Centralization means less collateral, less guarantee. It means less risk, in fact. And so the fact that custodial exchanges in crypto are not structured with a central clearinghouse, it's an understandable choice in a decentralized world, but it means that my counterpart risk as an investor is not going down anytime soon. So that's really the first one, and then there are a number of other ones. Liquidity is one of them, and then you have different things. But really the one that I want to focus on early on is counterpart risk, because that's one of the major ones I see in crypto. Not
Yeah,
at all.
and Oscar, we were talking about the counterparty risk regarding the Luna crash. Do you want to delve into this?
Yeah, how can the regulators have foreseen or helped to mitigate this risk that you've seen with Luna and an extension, what you've seen with Celsius now, and it seems that with the halting of trade on the exchanges as well, it's really the risk has not been properly managed or foreseen as it would have in traditional markets.
That's, yeah, because it's exactly what's going on, right?
Now let me add a word about that because it's a see the crypto space has been designed, has been written, has been coded by people who are essentially geeks. Okay, this is not a judgment, by the way. Okay, you can be very smart and very geeky. There's no judgment in calling someone a geek, but those are people with a lot of tech, with a deep appetite for tech, okay, and with the very strong belief that tech can solve anything. Well, the fact of the matter, and you know that very early, and you learn that very early when you're trading on finance, is that tech doesn't solve anything, or it doesn't solve everything. You need to have judgment, you need to have appreciation, you need to have experience. Okay, so when you're going to a trading floor, the first thing that the risk manager will request is an automated format for your risk management risk analysis. So you have predefined scenarios and so on and so forth. So that's the tech part. You can simulate whatever you want. You can replay some scenarios from the crack in 87 and 2008, and you can do a number of things. That's where the tech comes in. Fine. But at the end of the day, what do you do? Tech doesn't mean it's actionable. You need a judgment. You need somebody to make a decision and decide whether or not you reduce your risk and whether or not the stress test includes every component. And that's what happened with Terra. If you ask me, you can have incentives, you can have algorithms, you can have a lot of things hard-coded to do risk management. At the end of the day, when the confidence is not here, people will not behave as they were supposed to behave. So with all the incentives of the world, people will not come in and market make your token because confidence is not there, because risk appetite comes and goes, and especially in terms of crisis. And those are things traders and financial risk managers know. They know that the hypothesis on paper will not materialize, and you should have a stress test. And the stress test is not only about tech, it's also about, okay, what happens if the tech functions properly, but then the risk appetite is not there, liquidity is not there, investors do not behave as they are supposed to. And that's what was missing in the Terra debacle, and probably what is missing in a number of other places. The idea that you could replace risk management and experience with algorithms is very, very interesting. It's very cost efficient. It just doesn't work that way.
So what risks do you see now? I want to touch on the stable coins, the other stable coins. Is there a risk of, for instance, Tether has seen a massive adjustment to its market capitalization? I want to hear your comments on what you can see in the data and what further ripple effects are at stake.
So we've talked about it before. So I know of course that Tether is a very a touchy subject. Okay, there's been a lot of comments, a lot of speculation about Tether and so on and so forth. Let me start by saying by giving one piece of information. There is something which is called an ETF, exchange traded fund, in the traditional finance. An ETF is a fund, so it's a legal format of a fund. It has two characteristics. The first one is traded on exchange. Okay, fine. So you can buy it and sell it on exchange. The second characteristic, it's creatable and redeemable. So you can take the asset. For example, if you have an S&P 500, the SPDR, which is a trust, an ETF trust on the S&P 500 index, you can take the shares and bring it to the index sponsor and the S&P 500 shares, and you can create shares of the ETF, or you can do the other way around. take the ETF shares and bring them to the sponsor. Okay, why I'm talking about that? Because Tether is supposed to be working the same way. So you can bring in money and you get the tokens, or you can bring in the token and get the money. Okay, so it's a mechanism which is very common. There's nothing new right there. So you create and redeem shares of the fund as you would for any other fund, except it's not a fund, except it's not regulated, except Tether doesn't have any obligation to publish its reserves, for that matter, to publish anything, because it's incorporated in a jurisdiction, British Virgin Island, if I'm not mistaken, and there are a couple of companies involved, so maybe not all of them are incorporated in the British Virgin Island, but those jurisdictions do not necessarily force disclosure or transparency. So as of today, do we have a full certainty about Tether reserves? I don't, because from what I've seen on their website and what I've seen in terms of public information, I found it to be unconvincing. Okay, so the mechanism is something that exists, but it exists in a world where regulation is very heavy and investors are protected. In the world of crypto, the same mechanism exists, except it doesn't provide the same level of protection. So to your question, are there questions about Tether? Of course, there are questions about Tether. And when you're talking to people in the crypto space, everybody has the same question. Whether or not they are asking them publicly is a different matter, but everybody is asking them privately. Is Tether really holding all its reserves as it should or not? Okay. So I tend to think that there would be easy ways for the company to provide full proof of their reserves, which would be to go and see any central bank anywhere and ask for an audit. I'm still uncertain as to why they're not doing it. Okay. Now, the fact that the volume of Tether, the capitalization of Tether will increase and decrease with the market is a very interesting aspect. Okay. If you look at the volume of money in circulation in an economy, when you have economic growth, the volume of money tends to, the monetary mass tends to increase and vice versa. With Tether, you see similar effect. There's been a lot of increase in capitalization when the market was moving up, and there's been a lot of decrease when the market was moving down. So Tether reminds us of a central bank, okay? Because a lot of transactions are done against stablecoin. People are buying and selling in stablecoin. So if the prices go up, then the inventory of stablecoin needs to go up and down. So the mechanism, again, reminds us of an exchange traded fund on one side, and then a central bank on the other. Okay, when you have said that, you're starting to see a picture where Tether plays a very significant role in the ecosystem. It provides liquidity, safe liquidity, so that you can take your risk off and still stay in the crypto system without exiting the crypto system. So where I'm taking you to a place where Tether has a very particular role to play. It has a very big capitalization, and yet there is no agreed standard of auditing, and there is no real convincing institutional proof of the fact that that's its reserves. So it's a key point of failure, because there's just no way of saying otherwise. And because it has taken such a very big importance in the ecosystem, it's a point of failure which is become more and more visible. Okay, now there's been a lot of theories and going around about the fact that there was manipulation, there was creation of Tether that was meant to facilitate the buying of Bitcoin in the market in 2017. There were people publishing. A few people published an article about that, and then the same speculation has been going on. I don't know whether that's true or not. I have no way of knowing. Okay, but certainly there's been some strange coincidences between some movements on one side on capitalization and on the Bitcoin on the other. So again, if Tether plays such an important role in the ecosystem and in the direction of price movements, maybe we should consider more regulation. And that's, by the way, exactly what the US authorities are saying. They're saying, okay, stablecoins play a very particular role, so we should regulate them. And by the way, we shouldn't be targeting light regulation. We should be targeting the same regulation that we apply to critical elements of the traditional financial system, which are monetary funds. So the MMF, money market fund, is a very old construct in traditional finance. And essentially what the Fed and regulators in the US are saying is the same cause and having the same effect, we should regulate stablecoins the same way we regulate money market funds, which is very heavy regulation because we're talking about an instrument that is paramount to the proper functioning of modern capital markets. By the way, when Lehman failed in 2008, the first point of data that showed there was a significant crisis in liquidity was money market fund. It was one particular money market fund that essentially failed, and its net asset value decreased very quickly and abruptly because of market losses. That was the first sign and the most important sign that there was a big problem coming up. And the regulation of MMF has since evolved significantly. But the same reasoning applies to stablecoin. If they do play such a role in crypto finance, then they should be regulated in similar fashion.
So I want to ask, in a hypothetical scenario, let's say that the Tether is not backed as they claim it is, and there's a run on Tether. Everybody cashes in their Tether, and their bluff would be called because they don't have the resource, the liquidity to pay out. And as I understand it, then Tether would be depegged and lose its value. And let's say that stable coins no longer has the faith in the market. What would be the impact on the crypto industry overall when there isn't this function of stable coins as they are used today as a conduit between getting money out of exchanges into bank accounts and trading on exchanges?
Well, let me put it this way. If you buy an asset because it's a risk-off asset, that is, you want to remain in the crypto system, but you want to manage risk and don't carry market risk anymore. And if that asset turns out to be, in fact, a very risky asset because its spec value doesn't hold anymore, but then the world collapses. Okay, it's like you are buying US government bonds because they are a safe asset, and suddenly you realize that it's not safe anymore and it's worth 50, 60, 70 cents on the dollar, then nothing is safe anymore. Okay, so that's the first point of answer. If we were to discover that Tether is not backed and that the spec $1 value doesn't hold, it's the end of trust and confidence in the system. It's the end of Tether, by the way, first and foremost, and that would probably bring in a lot of class action and so on. But that would be the end of the confidence you can have in the overall system, because the riskless asset you hold, and in finance, in theoretical finance, there is always a riskless asset. I mean, in Black-Scholes and all those things, there is always a riskless asset. So if that asset turns out to be not riskless, but risky, then you have a major problem. So the confidence in the market would evaporate, and most probably a lot of people would run for the exit, which would mean a crack. It would mean a crash probably of the magnitude of the ones we've seen in May last year, and of the ones we've seen over the past few months. Okay, so it's a very, very serious blow to the overall credibility of the crypto ecosystem, which is a systemic risk. We call that in finance a systemic risk. So risks that the system would essentially fail. Okay. So that at the first order, this is really what you could expect, because the most basic element fails to hold its promises. Now,
so
go ahead, Oscar.
Just so what you are saying then is that much of the crypto industry is very much dependent on the stable coins. And if there is an uncertainty about the backing of Tether, which is the biggest stable coin, shouldn't the crypto industry look to de-risk itself from its dependence on Tether? And wouldn't a Fed coin solve the problem of simply being the conduit that Tether serves as today?
The answer is yes, but let me come back to the early part of your question. What I'm essentially saying is that in the world of crypto, which is built on different assumptions than the traditional finance, but in fact, an algorithmic one. The idea that you can build trust through an algorithm, whether it's the proof of work or whatever consensus you can implement, that in fact is not true. You need trust and confidence. You need trust and confidence. In the particular case of Tether, you need to convince yourself that Tether has its reserves. Otherwise, you will never enter into crypto space and hold Tether. And if you don't hold Tether, why would you hold another stable coin? Because some of them are more regulated, but at the end of the day, none of them is really regulated like a money market fund. So that ecosystem needs confidence. Whether it wants it or not, it's a very important part of the fabric of the system. Okay. That is probably not going to be accepted widely because the crypto ecosystem has been built on the rejection of confidence as an important element. It's predicated on the fact that you can hard code everything and everything will be okay. But we are past the point where this is not true anymore. Terra is the proof that it just doesn't work. The world doesn't work that way. Number one. Number two, you said, okay, if Tether has a problem, if Tether has a big problem, number one, how much of a problem would it have? If you recall 2008 and the subprime issue, a big uncertainty and a big element in the crisis, we knew that the banks were holding assets that were not valued at their fair value. We just didn't know how much that value was. So the variance on the value simply made any calculation very difficult. What I'm saying is essentially you didn't know Lehman failed, but for the others that stayed alive, without transparency and without clear visibility on their balance sheet, you essentially were not able to say whether they were still alive or dead. Okay, so not the fact that there's a problem is one point, but the magnitude of the problem is the second point, and you need clarity on the magnitude of the problem. So in answer, if you apply this reasoning to Tether, it's one thing to know that Tether doesn't have enough reserves. It's another thing to know how far we are from the truth, because 5% is not 50%, which is not 70%. So that's the second element of answer. Now, the third thing you said is, okay, now shouldn't the crypto ecosystem and investors try to move away from such a systemic risk? Okay, in theory, you're right. People should move away from that. And there are different ways to move away from that. Number one, you could move away from Tether itself, try to go into stable coins that are regulated in differently and if possible that are more regulated. That's one way to do that. But another way would be to request Tether more transparency. Simply ask the firm and try to get the firm to provide the transparency that everybody needs. As far as I'm aware, this second option is not happening. And maybe I'm missing something, but I'm not seeing a lot of noise around full disclosure, around enhanced disclosure of Tether. Apparently, a lot of people are being satisfied by what the company puts out on its website and so on and so forth. Okay, which is to me is very surprising. But anyway, it seems to be the case. So shouldn't the ecosystem ask for more safety? Probably. Should it move away? It depends on how much of safety is on the horizon and so on. Should the ecosystem be ready to accept, be willing to accept more regulation? Absolutely, especially on that compartment. Okay, is it the case? I don't know. It doesn't feel like the ecosystem is willing to accept much more regulation on stablecoins, but it certainly feels that the regulator has identified that compartment to be in need of more regulation. Essentially, I'm convinced that they have been looking at stablecoin the same way a lot of people have been looking at stablecoin, including myself, which is it's a very key element because it's supposed to be risk-free. It has to be risk-free because that's the foundation on which you build everything else. So if it's not risk-free, then we have a serious problem. And I'm sure the regulator are aligned with that, and in particular with Tether, because Tether seems to be the biggest one, and they are still 50 or 70 billion, even if it decreased recently, they are still very, very big. So should the ecosystem request more transparency / regulation? Yes. Are they? I don't know, but certainly the regulator is pushing in that direction.
Yeah, what are your thoughts, Hayate?
Well, I hear a lot of our crypto people say that they have gone away from USDT, but you just said that USDC and all those other stable coins are not as regulated as traditional finance either. So yes, we probably have to go deeper into the regulations especially for stablecoin then, like you say.
But how has Tether managed to get the position that it has? I mean, seeing that the function of Tether is to be pegged to the dollar, and then you've got the similar issues with other stable coins that are Coinbase stating that if it goes bankrupt, it would go to its creditors before you can claim their stable coins, as I understand. This doesn't seem very convincing to me either as being the currency of the crypto industry. I mean, what is the long-term solution to these issues? I mean, you need to know what currency you're holding.
Okay, the first question you asked, Oscar, is whether how we came to be in that situation. Okay, so let's say I'm a manager of Tether token. Okay, let's say I have 100 million of Tether, 100 million of reserves. What prevents me from issuing 100 million more Tethers in the form of tokens, using them to buy Bitcoin and place that Bitcoin back in the reserve?
Mm-hmm.
Nothing. At the end of that exercise, I am finding myself with 200 million of Tether and 200 million of Bitcoin. Okay, so if I was a regulated entity and money market fund, there would be no way for me to do that, because I would print shares of the fund before I receive money, which is absolutely impossible in traditional finance. Is it impossible in the world of crypto finance? I don't think so. Okay, so how do we, and I'm not saying that Tether did that, I just don't know. But what I'm saying is it's certainly possible to envision that they would be doing that, which, by the way, would have the peripheral effect of pushing Bitcoin price up, because suddenly I have 100 million of Bitcoin to buy. Okay, that essentially is what some people say happened in 2017. And again, I don't know, so I'm not pushing any accusation. What I'm saying is, if you think about it, certainly it's very, very possible. Okay, what's the problem with that situation? Well, there are a few problems. Number one is, if you do that and you haven't disclosed that you would be willing to do that, then you're essentially lying on your business. Okay, if you tell people, okay, I'm going to take the liberty of printing Tethers or printing any stable coin, and I will use that inventory to buy any other coin that I see fit, fine, you say that and you do it, and there's no problem. People will buy Tether because they've been informed. If you haven't informed anybody, then you're finding yourself in breach of confidence, because that's not what you are supposed to do. So that's the first problem, breach of confidence. The second problem is that suddenly you have Tether backed by collateral, which is Bitcoin, and the value of that collateral is supposed to is susceptible to move. Okay, so if the Bitcoin is divided by 2, then I don't have 200 million of Bitcoin, I have 200 million of Tether, and then 100 million of Bitcoin, which essentially breaks the parity. So the second problem is, I find myself in a situation where I'm under collateralized on the claims of my issuance of Tether. Why am I under collateralized? Because I've bought an asset which is not safe. Okay. Except that in that particular case, you don't have the Tether anymore. So you could reduce your Tether inventory and burn those tokens, except you don't have them because you spend them to buy Bitcoin. Okay. So you don't have control over the inventory. Okay. So you find yourself in a typical situation of a Ponzi scheme, where you have a claim that is being that is not being protected or guaranteed by real assets, but it's protected by a claim on collateral, and that collateral doesn't have the value that it's supposed to have. Okay, that is also a very serious problem. And again, I'm not saying that's the case, but what I'm saying, it's very possible to envision that Tether at some point was in that situation, if they decided to print Tether to buy stablecoin, to buy a Bitcoin or any other coin for that matter. So that's why it's very important to know what Tether has in terms of reserves. If they have cash or cash equivalent or government bonds or certificate of deposit and so on, fine, that the collateral is safe and the value of the token is safe. But if they don't have those reserves but have other types of reserves, then the peg is another question. So it's not only a question of amount of reserves versus token issued, it's a question of risk. I may have the proper reserves today, but I may not have the proper reserve tomorrow because I'm exposed to market risk. So it may be all fine today, and then tomorrow, suddenly, if Bitcoin loses 20%, I find myself 20% under collateralized. So there is an element of inventory, static inventory, what are the reserves today, and there's an element of dynamic inventory, what will those become tomorrow? And that's true of Tether, but it's true of any stablecoin. By the way, it was true of Terra. It was an algorithmic stablecoin, but it was maintained with reserves that were supposed to obey a certain algorithm, and eventually it broke down. This is true across all stablecoins. You have an element of inventory. Am I collateralized properly now? And what is going to happen if my collateral loses in value? Okay. And so, because those are supposed to be the risk-free asset, again and again, we come back to that. I'm not supposed to be exposed. The collateralization of the assets, that is risk management 101. I spent my entire career looking at collateralized transactions. This is what we do all day long in securities finance. You lend money and you collateralize that, and the first thing you do is you check the value of the collateral, and you anticipate when that collateral will increase or decrease in value, and you adjust through margin calls. So if those stablecoins, Tether being one of them, don't have a proper risk management practice in place, and we are heading for very serious problems, especially right now when the market is very low.
I mean, my view on this is the mere fact that we don't have these answers without making any accusations on Tether and other stable coins, to me is a very serious problem when you're dealing with an exchange, and something that regulators have to address, because the whole assumption is that, as you're saying, I mean, the other coins that are not, I mean, the other cryptocurrencies, they have a relative value, whatever they are trading at. But the assumption with the stable coin is that the value you have in stable coins is the risk-free asset that is in the system. So how can regulators address this in terms of, I mean, everyone is competing to become the crypto capital of the world, and licensing exchanges. That's one question. I want to move that on to the accountability and recourse in the case of crypto exchanges being hacked and you lose all your funds. What are the responsibilities of regulators in such a case?
Before we get to that, let me comment on one of the things you said. You said whether there was a federal digital dollar. I mean, if there was a federal digital dollar, it would essentially solve those problems entirely. You could have a digital federal dollar on the blockchain somewhere, and you could use that to buy Bitcoin or any kind of other token. So, but that, by the way, there's one solution. You can go and audit stablecoins reserves, of course, but another solution would be to accept the idea of an official dollar, a digital dollar. That would also be an acceptable solution. It doesn't kill the crypto ecosystem; it helps them tremendously. Okay, so that's one quick remark on what you said. Now, coming back to exchanges, what you have to understand, and I need to put a bit of to explain a few things. When you need to understand with capital market finance is the counterpart risk is managed in a very specific way. Okay, so let me explain. If we trade together, Oscar, and we trade on through an OTC, we do a swap, we do whatever we do a financial transaction, and the value of that transaction will change every day with mark to market. Okay, so someday I will owe you money, someday you will owe me money. Okay. So what we do is we put in place margin calls between us. The margin call is the mark to market, meaning when you owe me money, you actually pay me that money, so that if you go and if you become insolvent from one day to the next, then I don't lose any money. Or if you God forbid, fall under a car or a bus or whatever, then I don't lose money in that transaction. Okay, so the idea is we have margin calls, and those margin calls are being paid out every day. Okay, between financial institutions, it's the same. Now, the problem with that is you have to operate in a legal system whereby if the corporation fails, I find my money back. If my counterpart fails, I find my money back. As it happens, this is not the case under common law, because you have a Chapter 7 or liquidation or Chapter 11. Essentially, when a corporation fails, it's taken over by an administrator and everything is frozen. And so under common law practice, if two corporations or two financial institutions do business together, and if one of them fails, then the other one doesn't get its mark-to-market or its collateral or its guarantee. It loses money because the standard practice is for the administrator to freeze everything. Okay, now the answer that capital markets have brought to that problem is to have a specific exceptions. Okay, so you have a part of the law that says that under specific circumstances, if you're a regulated institution, if you enter an OTC transaction with someone, then you can reclaim your guarantee even before the administrator freezes the assets. Okay, so that's a first degree protection for specific financial transactions as an exception to the liquidation code or to the administration code that you have under common law for corporate law. Okay, what do I mean by that? I mean by that, then when you are, the reason why I'm going to do business with you is that I know, because it's written in this specific exception, that if you fail, I'm going to get my money back before anybody else, before even your spouse or before your children, before anybody gets money. I'm going to be reimbursed what you owe me because we are trading or we are doing business under a specific exception to the liquidation code and so on and so forth. Okay, so once you understand that, what it means is to operate safely, financial institutions need to be under a specific exception from the general common law of insolvency or bankruptcy protection. Okay, when you don't have that and your counterparty fails, it means that you're going to see an insolvency judge and you're going to wait in line like everybody else before you get your money. Okay, so the reason why I'm explaining this in no details is Coinbase released a statement very recently. They said that they reminded those investors that those investors were common debt holder if the company went bankrupt. They were not the beneficiaries of any particular protection. So if you are an account holder at Coinbase and Coinbase fails, you're not going to get any protection, specific protection, similar to the one you would be getting if a bank failed, because a bank is subject to the exception, and the regulatory banking world says that if you have your money at a bank, you are a creditor of the bank, and that money is earmarked for you. And if you're a financial institution and you trade with a bank, there is a margin call somewhere that you are entitled to keep. That's an exception to the law. Coinbase and many others, by the way, don't fall into that exception because they are not regulated as financial institutions. So if you're an account holder at Coinbase and Coinbase fails, you're not going to get your money. You're going to wait in line like everybody else. When there is a corporate failure or there's a corporate insolvency, everybody waits to be paid. It takes whatever it takes in terms of time, and you're getting the money you're getting only depends on assets, liabilities. There's usually less assets than liabilities, otherwise you don't go under, and you're getting paid whatever you're getting paid when you're getting paid. And you have no certainty about the amount and you have certainty about the time. Okay. Why did Coinbase take that step to remind its account holders of that specific point? I don't know. But the fact of the matter is that they did remind their account holder of that point because it's true. Because Coinbase, it's a corporation, it's regulated as a corporation, it's not a financial institution. And even though it does trading in Bitcoin and other digital assets, those not being regulated in the US as financial instruments, that corporation doesn't fall under the exception that I just mentioned. So its clients aren't getting any particular protection. Okay, so at the end of all this, you get a situation where nobody in the crypto space at Coinbase or any other for that matter is getting any particular protection. So you're just in line to get your asset if there is a liquidation, that is a huge difference to what's happening with any kind of bank anywhere in the world. Any
Or
decent,
any custodian of
or
a
any custodian, of course. The
so,
custodian,
so
go
what
ahead.
is this acceptable? Is this how it's going to be in the crypto market, or will it have to change to be?
My feeling, number one, Coinbase is being transparent about it. Okay, which is a very important point. So they're saying, look, guys, you have to wait in line. You're not getting the protection you would be getting from a financial institution, which is it's probably compulsory for them to say that. But it's fair that they're saying that so that their account holders can make an informed decision about whether or not they want to stay or whether or not they want to leave. So that's number one. Number two, that they have to change. I don't know how many accounts Coinbase has, but probably 50, 70 million. I don't know. So look, those people find it acceptable. So it's a question of risk appetite. Do I need to be protected if I do business with Coinbase? No, I don't need to be protected. If I'm told what my risk is, then it's up to me to decide whether or not I take it. Well, that's fair. Okay. Now, do I need more protection if I want to gain a more massive adoption? My opinion is yes. If you really want to go after the non-professional, non-financial public, to generally the common public, the layman, if you really want to go after that particular person and hope that this person will invest part of its savings in digital assets, you need to go all the way in terms of protection because that particular person doesn't have a clue about what I've just explained. They don't know, they don't want to know, they don't have a clue, they just want to be safe and comfortable. And when Coinbase makes this kind of statement, they don't even understand what it's about, in fact. So my conviction, but that's my personal conviction, is that for adoption to rise to the levels where anybody would be comfortable with part of its portfolio in digital assets, then the regulation would have to rise as well. And that regulation would have to converge to the standard of protection that are being offered to common investors in traditional financial market. So yes, I would advocate some sort of convergence. Okay, because protection, as I said, we are living in societies that are governed by laws, corporate law and financial regulation, and so that conversion seems to be a reasonable proposition if you really want to push for adoption in people in a population which is not sophisticated.
So what are you seeing among the capitals? I mean, Paris is looking to attract crypto exchanges. Dubai, we hear at World Trade Center with Vara, and Singapore is much in the spotlight, and Hong Kong. How do you see these different capitals?
We are not in the business of gathering intelligence on different platforms and different capitals. What we're seeing is France. So what I'm going to say may be approximate and maybe may not be 100% accurate, and I apologize for that. But what we're seeing is that France was a precursor in many ways. Okay, there were a couple of legal initiatives. One is the PSAN, the status, which is a regulated. It's not a regulated status per se, but it's a declaration where you just register with the regulator saying I'm going to do business on this particular asset or this particular type of business and so on. So that was. There was nothing new because there was a big license in New York and so on, but that was welcome at a time where there was a lot of uncertainty in the government. That was a way of saying the government would welcome the industry. Okay, and there were a few more things and items on accepting the blockchain technology as a register for corporate life. And you can register, you can hold the register of a fund company, of a corporation onto a blockchain, and it has legal strengths in terms of registry and so on. So there's been a number of things happening. The problem is it's always a thing. It's the end investor. It's a demand. Regulators in France, regulators in Europe, regulators in many jurisdictions always encounter the same difficulties. at the investor level, at the unsophisticated investor level, you need to add up protection. Okay, so you may attract all the people you want, you may attract the businesses, the activities, you may attract the fund manager, the exchanges, whatever type of business you want to attract on your territory. You will always end up asking the same question: how much protection do I want my non-professional investor to have? So the answer to that question is very difficult. The industry will say, okay, you should let them play. The regulators will say, I cannot accept this opinion. I should not let them play with their money without at least the beginnings of a protection similar to what they've been used to in traditional finance. And so regardless of where you are, where you operate, you always have the same question. Regulators that push for non-professional investors protection, and the industry that pushes for a lot more leeway in interpretations, sandbox feeling where, okay, give us a sandbox, we play in it, except the industry wants a very large sandbox with pretty much everybody in it. And the regulator said, there's no way I'm going to let you play with non-professional investors. So at the very least, I will let you play with QIPs, qualified investors. There's a notion of qualified investor in France, qualified investor in the US, and so on. So which jurisdiction is more comfortable with crypto? Probably the US, probably Singapore. In France, we have a crypto-friendly environment in general. The UK as well, Germany, I hear. China is obviously on the other end of the spectrum because China has a control problem. It wants to hold control over its currency and so on and so forth. So it really is on the other end of the spectrum. But we have a number of jurisdictions that are friendly to crypto businesses, but with always the same provision. Come on, guys, you need to do something about the non-professional investor because that one we cannot give you access to. It's too early, it's immature. And that question is really the source of friction and tension between the crypto ecosystem on one side and the regulatory apparatus on the other. France is no exception. So there is this registration idea that you can go and see the IMF regulator and obtain registration. It will help you because it's a proof of transparency. So the regulator will appreciate that you're going one step forward and you are making yourself known as a provider of crypto services. Yet it will not allow you to address any kind of investor. So even that registration is one step in the right direction. It doesn't open the doors to anybody's wallet, in fact. So now in terms of legislation and regulation, which one is more advanced, which one is more receptive and so on, I confess I cannot give you a definitive answer about that. But what I'm seeing in France in particular, but also in other places, is always the same, as I said, question, which is adoption. Regulators want to regulate adoption of non-professional investors because those are the ones that are the most where the money is. In fact, there's much more money in that compartment than there's money in the qualified investors. And institutionals, as we know, are a little bit late because they have custody problem, because they have regulatory problem in general. So the time where institutional investors will come in is not yet. Maybe they are looking at it, maybe they are playing a little bit, maybe they're asking questions, but they are not coming in en masse into the market.
It's been a very interesting discussion. Do you have any questions, Hayate?
I'm absolutely fine, thank you.
Yeah, so I think it's been a good hour. Do you have any concluding comments, Stephane, on what will you be talking about at the Future Blockchain Summit, and where do you see the market in October?
See, that's an easy question, Oscar. I'm a strong believer in the virtues of technology, and the blockchain is not exception to that. It's been tremendous in its effect. Number one, to ask questions, okay? Because even though I'm a proponent of regulation for all the reasons that I've exposed, I'm not naive, and then regulators need to be pushed. Need to be pushed sometimes. Okay, so they need to understand that competition is around the corner. Fintech is disrupting the financial traditional system, and that's very good because the traditional financial system has a strong tendency to forget about competition and to really refuse or deny any innovation and so on and so forth. And so at the end of the day, the individual investor is the one that pays for it. Okay, so the fact that the crypto ecosystem and the technology would push questions to the traditional system, to the monetary authorities that control inflation and so on, that's fantastic. Okay, what is money? What is currency? How much privacy do we need to have? How much censorship is acceptable? Those are questions that were not asked before, loudly, I mean. And that, as an individual, I think they are very, very good questions to ask. So the fact that technology would push the question forward and would force regulators, legislators, and the public, in fact, to answer seems to be, to me, it's a very, very good point. Now, this being said, innovation in and of itself is not sufficient to justify undoing a lot of things that have been done, in particular after 2008 and so on. So innovation in and of itself is not strong enough. It's not a strong enough driver to justify bypassing regulation that has been designed to protect investors. So what I'm going to say in terms of what I hope for is a very